There is an action that strikes fear and anxiety into the hearts of writers, entrepreneurs, artists, and adventurers everywhere. In physics, this motion requires disproportionately more energy than other types of force. This particular action is the reason it's challenging to get out of bed in the morning, and it's the reason that so many of us get stuck in counterproductive routines. Do you know what this action is? This action is the act of getting started. Introduction. In this discussion, we'll be leveraging financial and business fundamentals so you can spark motivation and organize your efforts like a multi-billion-dollar hedge fund. We will borrow thinking from the likes of Yuval Noah Harari, Ries, and Clayton Christensen. These financial fundamentals are tools that help us drive and establish value with dexterity and insight. Why do we invest? To be more effective at investing, let's first understand some of the mechanics and the history of investing. In the book Sapiens, A Brief History of Humankind, Yuval Harari explains how the concept of investment came to be. Harari describes what he calls the entrepreneur's dilemma. The entrepreneur's dilemma works like this. An entrepreneur wants to open a bakery to turn a profit. They currently don't have enough money to build a bakery, so their only choice is to keep saving up money until they have enough to build one. Since it takes a long time to acquire enough money, they either build very far in the future or they never get to build at all. There's a bit of a paradox here. The entrepreneur can only afford to build the bakery if they have already built the bakery. What sorcery could untangle this intractable paradox? None other than investment, with the magical power to bring things into existence from the future. Harari describes what he calls the magic circle of the modern economy. The linchpin that allows an investment to materialize is trust in the future. If we can just believe that the bakery will be successful, then we can get an investor who has excess money to extend credit to the builder. We can pay the contractors who will build new bakeries that will produce cakes and increase our trust in the future. The investor can ask for interest on their money, therefore making it profitable for them as well. As you can imagine, not all investments turn out to be positive, but we will get to that a little bit later. Additionally, the entrepreneur who took the loan will go into debt until they can pay it back. Even with the dangers of failed ventures and debt, there's so much utility to investment that the idea practically braces the structure of our society. What would happen if there was no such thing as investment and debt? While no one would have to worry about going into debt, the advance of society would seemingly grind to a halt. Imagine that it took 10 years to come up with the necessary funds to build a business or a project. That means it would take 10 times as long to build the same things. Even then, 10 years to come up with the funds is on the conservative side for big projects. The Hoover Dam, which was originally commissioned in 1935, took until 1987, 52 years, to be repaid in full. Borrow meaning from the future. We could apply the wizardry of investment to our personal lives using the same principle but using a different type of value. For us to take any action now as part of some longer-term initiative, we must first interact with our self-talk about our efforts. Similar to Yuval Harari's entrepreneur's dilemma, one's idea of the future influences actions in the present. The paradox will emerge again where our ideas of the future are directly responsible for how the future unfolds. If we imagine that the idea we are working on is going to be something meaningful, then our motivation in the present will be high and we will take action now, which leads to a successful outcome. Then, in reverse, if our idea of the future is that this project is a waste of time, we will not take any actions and then the project is sure to just remain an idea. However, the hesitation to apply effort towards something is not arbitrary. There are plenty of reasons why you might not want to put effort into something. Let's take a look at how things could go wrong and why you should most likely take action anyway. You miss 100% of the shots you don't take. This was the often repeated proverb by one of the greatest hockey players of all time, Wayne Gretzky. However, the part that Gretzky left out is that on average, 90.54% of shots taken in the NHL are a miss. Ironically enough, the average failure rate of a tech startup is also about 90%. Andreessen Horowitz is one of the most prestigious venture capital funds in Silicon Valley with over $28 billion in assets under management. If we do some quick math on the number of investments minus the number of IPOs, we get a successful investment rate of about 17.2%. In other words, if you gather some of the most intelligent and qualified minds in the world to make simple yes or no decisions, they would be right less often than you correctly pick black or red at the roulette table by a factor of 2.7 times. From this type of analysis, you might think that it's a bad idea to start on any risky project. But wait, it gets worse. Backward rationalizing results. For us to make correct guesses about the future, our appraisal models need to have veracity. However, in reality, not only do we often get it wrong, like venture capitalists, we often misattribute our correct guesses to erroneous events. The American financier Bernard Baruch once said, "Show me the charts and I'll show you the news." In the stock market, it's soothing to think that the reasons presented for price changes are reasons that we can understand. Despite our best efforts, however, the reasons for price movement may simply not be accessible to human understanding. This is because of the hundreds of thousands or millions of factors that can affect price fluctuations in either direction. This is the same as all the thousands or millions of factors that can lead to an individual finding success or failure in their lives. We might feel like we have a grip on why some projects make it and others don't, but we might never know. Marc Andreessen himself admits the lack of an ability to always pick winners. He says, "You want to tilt into the really radical ideas. But by their nature, you can't predict what they will be. It's really, really hard to predict those. I don't believe anyone can." From this, we can conclude that not only do we lack the ability to predict if something will succeed, but we may not be able to acutely explain why some people achieve and others do not. Yet when we look at the aggregate, we can say that the best strategy is to move forward anyway. Making money from being wrong. Even though Andreessen Horowitz rarely ever gets a correct answer, when they do make a correct call, they win quite big. As Marc Andreessen quoted, "The key characteristic of venture capital is that returns are a power law distribution. There are about 4,000 startups a year that are founded in the technology industry, which would like to raise venture capital. About 15 of those will generate 95% of all the economic returns. Notwithstanding the common knowledge that the vast majority of startups will fail, the following two truths remain for venture capital. 1. VC firms invest millions of dollars knowing that 83% of the time they will not get their money back. And number 2, the entrepreneurs that receive seed investment will continue to pursue progress until they run out of money. In this strange agreement between investor and entrepreneur, both will put themselves at risk knowing that the outcome is most likely to be negative. The investment, uncertainty, effort triangle. If we add the ingredients discussed so far, we can see that this is the only way an investment agreement can play out. These ingredients are: 1. Investment is orders of magnitude more efficient when it comes to building the future. 2. Even the best in the industry have no way of definitively knowing if an investment will succeed or not. And 3. When success is possible, the only way to reach it is to put in maximum effort. These three factors are always in tension with each other, as illustrated in the diagram. If you had complete certainty, then you would know how much effort to apply, but you will not get this certainty. You could try to apply efforts without investment, but at some point you will need funding to bootstrap big ideas. If you have an idea that seems like a sure bet and you have money in the bank, you still need to apply the effort to turn that outcome into a reality. The Innovators Dilemma. In the classic business book, The Innovators Dilemma, When New Technologies Cause Great Firms to Fail, Clayton M. Christensen demonstrates that innovation happens suddenly and disruptively. The graph shows the market composition for disruptive tech between new companies and established companies. Whenever a new tech was introduced, startup firms came to dominate the market share quickly. For example, 2 years after the 5 1/4 drive was introduced, 80% of the supply was controlled by new firms only. This is because the old firms were too entrenched in the old production methods and were too risk averse to make a change in time. What this means for you is that whenever you successfully introduce a disruptive change in your life, it could soon become the predominant force in your life. For example, Matt Damon had a relatively uneventful acting career before he wrote the screenplay for Good Will Hunting in 1994. The film was released to critical acclaim, receiving 9 Academy Award nominations. When Damon was asked to describe his overnight success, he said, "It was surreal. People talk about overnight success, but I've been working professionally for 11 years by the time Good Will Hunting hit. Still, the change is nearly indescribable. Going from total obscurity to walking down a street in New York and having everybody turn and look. How to navigate uncertainty." Per the investment uncertainty effort triangle, we know that we need to invest our full efforts to succeed. But can we find any tools to help us navigate this uncertainty? In the book, The Lean Startup, How Today's Entrepreneurs Use Continuous Innovation to Create Radically Successful Businesses, Ries provides us with just such tools. In the vision strategy product pyramid, we see that one should keep their core vision consistent, but be willing to pivot on strategy and product. Ries advocates continually responding to feedback from the markets and adapting your product until it finds its proper fit. We can accomplish this most effectively by following the build, measure, learn feedback loop illustrated in the book. In the case of Matt Damon, his vision was to be in film. After measuring the feedback from 11 years of not progressing, he decided to change his strategy. He pivoted from acting in other people's movies to writing his own script. As he iterated on the product, which in this case was the script, he gathered data and learned that he should change almost all of the content. In Damon's words, "The only scene that survived from that document, it survived verbatim, actually is the first time I meet Robin." We could use the advice from Lean Startup whether we are working on a business or whether we are practicing self-development. Conclusion. In this discussion, we learned that investing like the best and brightest doesn't mean investing with certainty. Credit and debt are concepts that strongly shape our society despite their capricious nature. To invest in yourself like a venture capitalist, you don't have to be a clairvoyant. You just need to be methodical about how you manage possibilities.